Hey guys, welcome back. So today we're going to talk all about loans, and specifically, small business loans. We're going to break down what they are, who they're for, and most importantly, how to figure out if one is the right move for your business.
So let's just start with the most basic question every founder has to ask themselves at some point. You need cash, right? But are you willing to give up a piece of your company to get it? If your gut reaction is no way, then you're already thinking about debt, and that's exactly where business loans live.
So what is a small business loan really? Well, it's pretty simple. It's a form of debt. A financial institution, like a bank or a credit union, gives you money for your business. The key thing to remember is, unlike with investors, you're not selling ownership. You're just borrowing cash that you're going to have to pay back.
All right, so let's get into the nitty-gritty. How does this whole process actually work? What's going on behind the scenes at the bank?
The model is actually really straightforward. Banks have money, right? They get it when people like you and me deposit cash into our checking and savings accounts. And one of the main ways they make their money is by lending our money out to small businesses. The crucial thing to get here is that it's a set process. You go in, you ask for a loan, and if you meet their requirements, they'll approve it. It's not about some subjective judgment call. They have a checklist, and if you meet the criteria, you're in.
And in terms of how much money we're talking about, there's a pretty wide range. You can see loans for as little as, say, $10,000, and I've seen them go all the way up to around $300,000. Now, if you need more than that, it's a whole different ballgame, kind of outside the scope of what we're talking about today.
Okay, so the process makes sense, but the real question is, should you even do it? Let's dig into the pros and cons, because this is where you really need to pay attention.
The biggest pro, the number one argument for getting a bank loan, is this number right here, 6%. Bank loans are some of the absolute cheapest money you can get. It's totally normal to find a small business loan with a 6% APR. That means after a whole year, you only owe 6% in interest. I mean, that is incredibly cheap, especially when you think about the alternative, which is giving away a piece of your company.
And this really lays out the whole trade-off, doesn't it? The pros are huge, super cheap money, and you keep 100% of your company. But the cons? Well, they're pretty serious. The bar to qualify is incredibly high. And if you default on that loan, meaning you can't pay it back, it can affect you personally. We're talking potential bankruptcy, or it could absolutely destroy your credit. That's a huge difference from an angel investment failing, where you just might ruin a relationship. This has real personal consequences.
So that brings us to the most important part. To figure out if you're ready for a loan, you have to stop thinking like an entrepreneur for a minute and start thinking like a banker.
This right here is everything. You have to get this into your head. A bank does not care about your billion-dollar idea. They don't care about the upside. They are not betting on you to become a huge success. All they care about is one thing: minimizing their risk. They just want to be as certain as possible that they're getting their money back.
So how do they minimize that risk? Well, they have a checklist. First, they want to see existing cash flow. Your business has to already be making some money. It proves you're not just a speculative idea. Second, they want to see assets, stuff they can seize and sell if you can't pay. And third, they want a track record. They typically will not even talk to you unless you have at least 2 years of financial history.
And that's the harsh reality for a lot of new businesses. If you're just starting out and don't have that 2-year history, getting a loan is going to be really, really hard. Now, the only exception I've ever really seen is if you already have a great long-standing relationship with that bank. If they know you, maybe they'll bend the rules a bit.
Okay, so now that you know how a bank thinks, what do you actually do? What's your next strategic move? Let's talk about the game plan.
First off, you have to know the right time and place for a loan. And that's for what we call expansion capital. This means you need money to grow a business that's already working. Think about it like this. Say you have a ton of orders to fill, but you don't have enough cash to actually buy the materials to make the product. That's the perfect situation for a bank loan. It's not about starting something new, it's about pouring gas on a fire that's already burning.
So here's your playbook. 1. Start a relationship with a bank early. Don't wait until you're desperate for cash. 2. Think about going to smaller, local banks and credit unions. They can sometimes be a little more flexible than the giant national chains. And 3, and this is the big one, when you pitch them, you have to pitch your business as a low-risk investment. Don't talk about changing the world. Talk about how you're a safe bet.
And hey, if the traditional bank route just doesn't sound like a good fit, there are other options out there. You've got peer-to-peer lending platforms or more modern, progressive lenders. They can be easier to qualify for, but, and this is a big but, the terms might not be as good.
You really have to read the fine print, because easier access to cash often comes at a price.
So in the end, it all comes down to this question you have to ask yourself. Is a loan the fuel your business needs to get to the next level, or is it a personal risk that you just can't afford to take right now? The answer is going to be different for everyone, and only you can decide which path is right for you.